Hello and welcome to Asian Insider. I'm your host, Bhagyashree Garekar, and we're recording this episode on Tuesday, the 14th of July, 2026. Our guest today is an expert on the world's largest economy, that is China. Dr. Logan Wright is a partner at the Rhodium Group, which is an American research and advisory firm. Logan is speaking to us from Washington, D.C. He has previously worked in Beijing and Hong Kong for more than 2 decades. He's also the author of a book that has China watchers excited, even though it's not yet released. We'll be talking about his book. Welcome, Logan.
Bhagya, thank you very much. Happy to be here.
So the story we're hearing about the Chinese economy at the moment is that it's expected to be growing at 4.5 to 5%, which sounds pretty good, but it is the lowest since 1991, I'll just note. And in a matter of hours, China is going to be releasing its report card for the second quarter of this year. Analysts say they expect to see a figure that's closer to 4.5% than 5%. What's your take, Logan, on the China growth story?
We think that growth is much, much lower than where Beijing has been reporting it ever since the weakness in the property sector really intensified starting in 2022. So we think that growth right now in the economy is close to, probably just barely above zero, probably 0 to 1% or so, and that the gap between Beijing's stated growth rates in the economy and actual economic performance is widening considerably. The disruptions from the Iran war have been considerable, not just because of shortages in fuel, which you haven't really seen, but because China's economy has such weak domestic demand that they cannot absorb higher input costs. And so the result has been, weakness in output, and weakness in domestic consumption. The headline fixed asset investment growth rate through May is negative for the full year. Retail sales has been negative in the second quarter, negative 0.6%, is probably close to zero. That's China's key indicator of headline consumption. So that would suggest that domestic demand growth in China broadly is very close to zero or slightly negative.
So that sounds like a pretty extreme scenario, 0%, whereas the government is talking of 4.5 to 5%. So I have two questions. Firstly, is yours a minority opinion, or is it, gaining ground among the U.S. Establishment or community? Mm-hmm.
I think we're unique simply because we're willing to put numbers on the degree of the distortion. I don't think there's any real, I think there's a widespread consensus that China's economic data overstates its economic growth, especially in terms of real GDP. The extent of that overstatement is difficult to track. What many of our clients are interested in is whether that gap between what Beijing is reporting and actual economic performance is widening or whether it is narrowing. Mm-hmm. And so I would argue it was widest in 2022 during the COVID lockdowns, the Shanghai lockdown, and COVID-related disruptions, when most indicators of economic activity were negative. China's new property housing starts declined by 40%. There were double-digit declines in virtually every measure of construction activity, and yet they reported headline GDP growth of 3%. This was wildly inconsistent at the time. The gap probably narrowed even as China said that it recovered in 2023, 2024, and 2025. That recovery was very shallow at the time. And since the middle of 2025, we've seen a very sharp cyclical slowdown in China that I think is underappreciated in markets, just how much things have weakened. And this is both structural in nature in terms of the weakness in overall credit growth, and also cyclical in terms of the slowdown that's resulted from some of the disruptions from the war in the Persian Gulf.
So you've been studying the Chinese economy for more than a decade, I think.
More than two, yes.
Right.
Been doing this for quite some time.
Right, and you have you laid out just now a number of factors that you say are showing up within the Chinese economy. So of the kind of things you laid out, what actually seizes you right now as the most troubling aspect of the Chinese economy?
The most troubling aspect is that basically the leadership has chosen to allow decay rather than reform the system or try to improve it. And so the book Broken China outlines this case for how China's financial system is central to understanding its slowdown. So basically, it's been underappreciated how much China's economic growth depended upon an enormous expansion of credit. In fact, the largest single country credit expansion in at least a century, possibly much longer. China added around a third of global GDP to its own bank assets in just 8 years, from 2008 to 2016. There's a tendency to look at China through a political lens. To sort of analysts tend to look at the Chinese system and say, this is a different political system. It produces outputs that are long-term plans. And so therefore we filter incoming data in terms of how China is doing based on its long-term plans and its declared goals. From a financial system perspective, it looks entirely different. This is a country that has had an enormous credit boom and bust. And you don't expect countries on the end of a credit bust, in the midst of a credit bust, to have the same policy capacity that they did at the start of it. Credit growth helps to make everyone look very, very, very competent and very, very far-sighted when credit is expanding. And everyone looks very, very different in terms of their policy capacity when credit is contracting. And that's basically been the case, really since 2018, but especially since 2022 and the collapse of the property sector. So, Beijing did not choose, and there was never part of a long-term plan to have one of the largest shadow banking systems in recent history. They did not choose to have a property bubble and a resulting adjustment of that sector, which was its largest, by over 70% over just 4 years. None of this has gone according to plan. And Beijing's result of the thing I'm worried about the most is that the result is that they are doubling down on this strategy of simply trying to continue to expand investment and exports. Because if you cannot generate domestic demand, then trade tensions are inevitable with the rest of the world, because you're basically not, if you're the world's largest investor at 26% of global investment, but only 12% of global consumption, and you remain an investment-led economy, China can only grow relative to the rest of the world by displacing investment abroad if they are not contributing to domestic demand growth at home. So this shift from tons of upstream industrial investment, enormous industries, steel, cement, commodities, petrochemicals, building buildings in China itself, to all of that upstream capacity now being exported to the rest of the world at lower prices, has resulted in a huge disruption in global trade flows and an expanding Chinese trade surplus. Most people look at China's export competitiveness and assume that that is the byproduct of, improving productivity. In reality, a lot of it is due to falling prices and, continued depreciation of the real exchange rate. So the concern I have is that Beijing is basically doubling down on these mistakes and permitting the continued decay of its fiscal and financial systems, because decay is simply a much easier choice than reform, if reform involves the actual imposition of costs to the domestic economy. And the book discusses these trade-offs and how we got here in far more detail.
Right. So many questions from what you said. But first, I'd like to ask you about, Chinese economic data. How good is that quality of that data? I think, I remember a conversation I had with Arthur Krobel of Dragonomics in Hong Kong, and that was 10 years ago or so. And when I asked him the same question, how good is the Chinese data? And I think even then he said, well, it's good enough. So what do you think? What's your take on that?
I think there used to be 10 years ago, there used to be a very reasonable debate about the quality of Chinese data and an argument that, whatever mistakes there were, they were likely occurring in both directions. So in other words, there was smoothing of the data, there were overstatements, there were understatements, they often worked out over time. The truth is China produces, it's not that data itself, we're talking about specific data series here. The difference between looking at China and looking at many other economies is that Beijing only wants a certain set of data series publicized. In reality, they produce thousands of them. The data we choose to spend the most time on is actually financial system data and what's happening to credit within the economy. So we assemble data from banks, non-bank financial institutions, figure out where money is flowing. We call it sort of a follow the money approach. And the reason is China is an investment-led economy. There's very weak operating cash flows throughout all of these companies that are receiving this credit and are driving this investment. They're not generally designed to generate cash. So the result is if you can figure out what's happening to credit, you can figure out what's happening to activity. So it's very meaningful that overall credit growth is now at an all-time low. It's very meaningful that the 58% of all bank loans extended right now are at or below the loan prime rate, which is only 3%. They are likely being extended to the same state-owned enterprises and local government financing vehicles. China likes to say we are pivoting to new growth drivers and channeling resources to new, more productive industries. There's very little evidence of that if you actually look at how credit is flowing in the system. So I think and then just on the data itself, the distortions, as I said, 10 years ago, there was a reasonable argument that China's data was just too smooth. If you look at GDP growth between 2014 and 2019, we've almost never seen that degree of smoothness in any developing or developed economy. We looked back at all of them over all the top 20 economies in the world over the last 50 years or so, and we could never see a data series so smooth. But since 2022, the errors are all in one direction. And it's quite obvious that if China was actually growing at 5% per year in 2023, 2024, and 2025, you wouldn't be seeing the same level of external imbalances, of trade surpluses, and you wouldn't be seeing the weakness in Chinese imports that you have seen. So I think right now there's only a realistic debate about the level of distortion in the degree of distortion in Chinese headline GDP data. There's not really a realistic debate that it should be taken seriously at face value. And frankly, I don't think most people within the Chinese system take it seriously. They view it as a communication mechanism between central and local authorities, because if Beijing said tomorrow that the GDP growth target is going to be 3%, virtually everyone's forecasts would readjust to 3% because that's likely what they would be reporting, and local governments would take that as a signal that they should be investing and less concerned about maintaining growth. And it's exactly that kind of signaling that is how you get to this sort of continuity in data reporting.
Got you. So like you say, it's like a feature of their system. But I want to ask you about the flip side, the more bullish side, which is basically about AI, the flavor of our times. Basically, Chinese AI, the models seem to be quite popular in the US. The companies here are using them. They say they are cheap and they're good enough. So the Chinese companies, as far as we can see, are doing well. DeepSeek has an IPO, I believe, coming soon. So the question is this: do you see AI delivering very good returns to the Chinese economy?
I think there's differences in returns to investors in that company, which may do very well, and returns to the economy as a whole, in which case it's actually part of. I would argue that this focus on improving technological productivity within the manufacturing sector, within industrial activity is arguably exacerbating the problems in the Chinese economy rather than solving them, because essentially the economy is unbalanced between investment and consumption. Unless your AI makes Chinese consumers that much richer, and there's really no sign of that. In fact, it's arguably displacing employment. I think that it's questionable how much that's actually happening worldwide. But if that's where the productivity gains will come from actually displacing employment, it doesn't really improve the underlying issue, which is that the marginal demand for everything produced in China is outside of China rather than inside of China. And so I always like to argue, look, even if you assume a very aggressive rate of industrial productivity growth from AI, from robotics, from advanced manufacturing, and I think there's reasons to question that at this point. It's not going to fundamentally, the critical issue is that might help you reform the fiscal and financial system, but it's not changing the ways in which the fiscal and financial system are allocating resources right now. Second of all, from an investment perspective, we have a report on our website, Rhodium Group. We added up all of the investments in the new strategic industries, electric vehicles, lithium-ion batteries, battery electric storage, solar panels, AI, robotics. There's a few others that we included as well. And we get a proportion using the 2023 input-output tables, which were recently released, and we obtain a level that's roughly around 6.3% of GDP at present, which means that all of these industries combined are still smaller than the property sector, even after the property sector's adjustment. And second of all, they're not growing that fast as a proportion of GDP. So you're already seeing attempts to use the anti-involution campaign to target electric vehicles, and even, you hear some noises around this in industrial robotics as well. These are not going to be, we can be wrong about those estimates. I don't think we're wrong by a factor of 2. So I don't think these industries are double the size of where we're expecting. And there's been many different attempts to sort of size these new strategic industries. So it will not replace investment growth in the same proportions, and will not be an alternate source of investment growth compared to where property and infrastructure were in the past. And that assumes, by our calculations, the declines in property and infrastructure investment and traditional vehicles have been around 6 times the acceleration in new strategic industry investments in the last 2 years.
So speaking of property, so the prices right now in China are at a 20-year low. That's a rough overall trend, although some cities, of course, are doing better than others. So you say, that obviously property is a large part of the Chinese economy. Do you have like a way to say how much of a drag is the property sector on the economy right now? And also, when do you see, or how do you see this dead weight kind of thing resolving?
Yeah, these are all sort of estimates that are out there, but if you take sort of the value added approach of looking at sort of the using input output tables to figure out the upstream and downstream implications of property construction, plus the value added in China's reported property GDP figures, that's the approach that Kenneth Rogoff and one of his co-authors used back in 2016. You get levels that are in the range, and there's many different estimates. You get levels in the range of property was 20 to 30% of GDP at its peak, and that peak was likely in 2021. And since then, new housing starts are down 77%. Overall sales are down 57%. This has been a collapse, no matter how you look at it. And so, the likely adjustment has been on the scale of, and by the way, when we talk about the overstatements in China's GDP growth, most of it is on the investment side. Consumption is probably overreported, but it's not by nearly the same margin. Most of it is about the overreporting of investment, and most of that is because of the adjustment of the property sector and infrastructure investment in recent years. So the likely adjustment has been on par of 10 to 12 percentage points of GDP in just the last 4 years. And sales are down 77%. We're likely, or starts are down 77%. We're likely closer to the end of this adjustment than it's likely to continue. The problem is the market is very segmented. So in interior cities, there's way too much building. There's not really any organic population growth. Most of these new apartments will be written down and probably won't have productive uses, or they'll be repurposed by local governments. In coastal cities, ironically, there's a supply shortage for properties where people actually want to move in, because there's what's available on the market is generally smaller housing stock. So it takes a while for all that stock to be built. And so things that are actually offered to the market are selling reasonably well. And you see a pickup in property sales in major cities this year as well, which may also be a reflection of some of the stock market performance in recent years also. The issue is that you can see a recovery there at some point, but developers cannot use pre-construction sales to the extent that they used to be able to. So in other words, they have to be confident enough that they're going to build apartments, and 2 years later, after they start this, there's still going to be demand out there. And fewer developers have had the financial cushions and the confidence that demand would be there to start that process. So that's really why the property sector is continuing to adjust. But I think, and we think that their actual housing construction right now, which if you look at the annualized housing starts, it's at roughly 390 million square meters annually, I believe, which would translate into 4.2 million new homes. That's probably way too low. It will probably continue to rally at some point. The problem is the financial conditions are not yet there to facilitate that rebound.
So in terms of a time frame, you can't put one on it? Like you can't,
I think that there were signs of property sector stabilization in late 2024. And you saw land sales improve. And the debate in 2025 was, you see land sales improve, but new starts are still down. Are new starts going to catch up to improvements in land sales, or are land sales going to weaken again? Well, land sales weakened again because local governments were too concerned about falling prices, and therefore they didn't want to put as much supply on the market. And so that's the forward pipeline of new construction that you see. So it's pretty much baked in the cake that property will continue to be a drag on the economy this year. I think next year it's still open to discussion, but when the sector rebounds, it's never going to rebound to its previous peak. There's just no demand out there fundamentally. It was overbuilt for years. So it likely rebounds to around 35-40% of its peak, which we think is around 550 to 650 million square meters per year.
Right. You refer to consumption, and we know that China's been trying to boost domestic consumption through a variety of ways. Do you see those policy efforts succeeding?
I think the issue is that it's how you think about, what do you think the constraint on consumption is at this point? And I think there are three arguments that are there's four, but there are three arguments that are central to this. One is that the constraint on consumption is household income. Incomes are too low. People can't spend what they don't have. The second is income inequality. So it doesn't matter if, incomes may be high, but they're unevenly distributed. So therefore, the rich just spend a lower proportion of their income. The third argument you hear is that savings rates are too high. I think this is true primarily at lower income strata, only for migrant workers. Even if you took rural savings rates and cut them in half overnight, based on our math, it would only generate 0.6% of GDP in new household consumption. And the fourth is about household debt levels preventing consumption. But those are actually coming down because of the deleveraging in the property sector. So the real problem is income growth. And so the answer to your question is Beijing really doing anything to restore income growth and to mitigate income inequality in terms of the distribution of that income growth? And you don't really see any of those tools. This is, fundamentally, that reform has to come from the fiscal system. It has to come from government allocations of fiscal revenues, changing the way in which the tax system works, changing what is taxed and how tax revenue is distributed. that is exactly, and I discussed this in Broken China in the book, that is exactly why um, consumption is limited, because there have been no such structural reforms. Because to change the way in which the tax system works requires changing the entire structure of the economy. If you shifted the economic foundation of China's growth to domestic consumption and didn't change the tax system only taxes investment, value added tax, enterprise income tax. There's very few taxes on domestic consumption. If you shifted the economic model without changing the system, it would bankrupt the government. So this is the issue, that you need to find new ways to actually broaden the tax base, but that involves actually taxing domestic consumption in a different way. And so that is probably going to reduce consumption in the short term. This is exactly why Beijing's choices are so stark, and why I characterize this. It is not crisis or collapse, it is decay. And covering up that decay requires publishing economic data that everyone thinks is more stable than it actually is. And this is why what you have is sort of the transformation of economic policies that are focused on generating outcomes to economic policies that are focused on generating narratives. You notice China doesn't really talk about overtaking the United States in GDP terms anymore, because it's not a realistic objective. And you don't really, instead you hear about AI, and you hear about, you hear about different technological developments. You hear about electric vehicles. You don't hear about the same kinds of things.
Right. Now, it's been documented that the number of workers in the Chinese economy is shrinking. The births hit a record low last year, 2025, and the deaths hit a record high. These demographic changes, how do you look at them? Will they have a very large impact on growth?
I think it's underappreciated just how shocking the demographics are when you look at them in more detail. Probably the most shocking statistic that China released last year was the level of births, which was only 7.92, 7.95. It was around 7.9 million births. The deaths are likely to accelerate in the next decade or so, because life expectancy in China is around 79, but the average age at which people die is around 73. And so there was a baby boom after 1949, and so that wave of deaths is likely to accelerate, which means that China could probably lose in the range of 50 to 60 million people from its population in just the next decade. And it doesn't look better if births continue declining beyond that as well. So you just have not seen this kind of demographic adjustment in many of the world's largest economies in the past. None of them have grown. None of the countries that have seen declining labor forces have, and there are very few, have seen growth over 3%. During those time frames. And so I think it is far more considerable, especially if you're talking about rebalancing the economy toward domestic consumption, because you simply have fewer consumers. You need to raise per capita consumption growth by larger proportions. But the market itself to anchor this is weaker.
So what I want to ask you about is about China's huge production capacity, the largest manufacturing economy in the world, and that's created, as you know, a threat for the manufacturing economies of Southeast Asia. Have you examined this issue, and do you think that's going to worsen?
We have. There's several Rhodium papers on our website that have chronicled this. This is a surprising squeeze that's happened in Southeast Asian economies, because China's surplus has expanded most aggressively in Asia, and in Southeast Asia in particular. Why is that? Because first, China is expanding higher tech exports and expanding exports to ASEAN economies that are being used for rebuilding ASEAN supply chains, but they're also still competing in low and mid tech industries. And so the net result is that imports from China, Chinese imports from Southeast Asia have collapsed. And so you see an increasing concentration of Chinese export market share in Southeast Asian economies in particular. And this reflects the weakness of China's domestic demand, but also the depreciation of the real exchange rate and the continued competitiveness of many of these economies. So this is, I think, where the overcapacity problem is in a way most intense. And it's where different Southeast Asian economies have to, basically make decisions about where they want to invest, where they want to rely upon Chinese value added for cheaper intermediate imports, and where they want to sort of compete with China in third markets as well. So I think this is really some of the central arena for discussions of where China's overcapacity is impacting regional economies.
Right. So before we close, an important question: when does your book come out? Can you give us the title and one reason why people in Singapore and maybe the rest of Asia must read it?
Absolutely. So thank you for giving me the opportunity. The book is called Broken China. This is not meant to be, how the economic miracle shattered and what it means for the world. This is not meant to be, provocative. This is another bearish book on China. What I mean with the title is that if you understand that the fiscal and financial system are constrained and that Beijing cannot reform them, it means that we shouldn't be wasting time or effort trying to encourage Beijing to make policy choices. It is meant to force the world to think about what the next policy steps are, how you can adapt and react to the fact that China cannot generate domestic demand, which dramatically changes your expectations of growth in China itself. And I think in Southeast Asia, it's vitally important that these decisions are made, because these are some of the most dynamic economies in the world, with growing populations, with growing consumer markets. And that gives Southeast Asian economies a huge foundation in which they can invest themselves. And you want to invest in themselves and do not want to basically be constantly on the back foot in terms of defending against Chinese competition that is occurring largely because of an overextended financial system and an economy that doesn't have other options besides exporting, besides expanding its exports. The book is out in the UK in 2 weeks on the 24th. It'll be out in the US on September 28th, and in other markets sort of incrementally after that, with many, many different dates. It'll be available since then. So please pick it up if you're interested in this viewpoint, and would be happy and really appreciate you giving me the opportunity to speak about it.
Absolutely. I look forward to reading it. And thank you for all the insights, Logan. We hope our audience enjoyed the show as well, and will share it around. Check out also our weekly Asian Insider newsletter that brings you great reporting from around Asia. This is Asian Insider. I'm Bhagyashree Garekar. The episode was produced and edited by Faiza Sani. Thank you for joining us, and we look forward to seeing you in the next episode.